5-minute tax guides from your 5-minute tax guy. Short lessons to help you navigate the treacherous, hazardous, and totally unpredictable U.S. federal tax code. Okay, I've got to get something off my chest right now before we go any further. Many of you have been telling me, 5-minute tax guy, how come your videos are 8, 9, 10 minutes long? I thought you were the 5-minute tax guy. Listen, when I say that a video is 5 minutes long, what I mean is it's between 5 and 10 minutes long. I thought everybody understood that. You can't explain the U.S. federal tax code in 5 minutes. The U.S. federal tax code is over 75,000 pages long. Take my word for it, I Googled it. And that was in 2014, where the new Tax Cuts and Jobs Act that Congress passed in December, effective for the 2018 tax year, I guesstimate that page count probably went up about 10,000 pages. By now it's probably about a jillion pages long. So if I take an extra 3, 4, or 5 minutes to try to explain it, I think that it's perfectly justified, don't you think? Well, that little rant added another minute to my video. Happy now? Adjustments to income. Adjustments to income are deductions from your gross income and are sometimes referred to as above-the-line deductions. In tax years 2017 and prior, they show up on the front of the Form 1040 at the bottom of the page and are deducted from your gross income to arrive at your adjusted gross income. Under the new Tax Cuts and Jobs Act, adjustments to income are now shown on a separate Schedule 1 entitled Additional Income and Adjustments to Income. Individual retirement arrangement. In this video, we cover the subject of IRA plans. An individual retirement arrangement, or IRA, is a personal savings plan that gives you tax advantages for setting aside money for your retirement. There are two types of IRAs, Roth IRA and traditional IRA. Roth IRA. A Roth IRA is similar to a traditional IRA except that the contributions are not deductible and the distributions are generally not taxable. We will not discuss Roth IRAs in this video. Traditional IRA. A traditional IRA is any IRA that isn't a Roth IRA. Two advantages of a traditional IRA are you may be able to deduct some or all of your contributions, depending on your circumstances, and generally amounts in your IRA, including earnings and gains, aren't taxed until they are distributed. Traditional IRA. Who can open a traditional IRA? You can open and make contributions to a traditional IRA if you, or if you file a joint return, your spouse, received taxable compensation during the year, and you weren't age 70 and a half by the end of the year. What is compensation? Generally, compensation is what you earn from working. Compensation includes wages, salaries, tips, professional fees, bonuses, and other amounts you receive for providing personal services. The IRS treats as compensation any amount properly shown in Box 1 of Form W-2, Wage and Tax Statement. Compensation also includes commissions and taxable alimony and separate maintenance payments. Non-taxable combat pay. For IRA purposes, if you are a member of the U.S. Armed Forces, your compensation includes any non-taxable combat pay you receive. What isn't compensation? Compensation doesn't include any of the following items: earnings and profits from property, such as rental income, interest income, and dividend income, pension or annuity income, deferred compensation received, which is compensation payments postponed from a prior year, income from a partnership for which you don't provide services that are a material income-producing factor. Any amounts other than combat pay you exclude from income, such as foreign earned income and housing costs. Self-employment income. If you're self-employed, compensation is the net earnings from your trade or business, provided your personal services are a material income-producing factor, reduced by the total of the deduction for contributions you made on your behalf to retirement plans and the deductible part of your self-employment tax. When can a traditional IRA be opened? You can open a traditional IRA at any time. However, the time for making contributions for any year is limited. Contributions must be made by due date. Contributions can be made to your traditional IRA for a year at any time during the year or by the due date for filing your return for that year, not including extensions. The age 70 and a half rule. Contributions can't be made to your traditional IRA for the year in which you reach age 70 and a half or for any later year. Designating year for which contribution is made. If an amount is contributed to your traditional IRA between January 1st and the due date of the return, you should tell the sponsor which year, the current year or the previous year, the contribution is for. If you don't tell the sponsor which year it is for, the sponsor can assume and report to the IRS that the contribution is for the current year, the year the sponsor received it. You can open different kinds of IRAs with a variety of organizations. You can open an IRA at a bank or other financial institution, or with a mutual fund or life insurance company. You can also open an IRA through your stockbroker. How much can be contributed? There are limits and other rules that affect the amount that can be contributed to a traditional IRA. The general limit for 2017 and 18, the most that can be contributed to your traditional IRA generally is the smaller of the following amounts: $5,500 or $6,500 if you're 50 or older, and your taxable compensation for the year. This is the most that can be contributed regardless of whether the contributions are to one or more traditional IRAs or whether all or part of the contributions are non-deductible. How much can you deduct? Generally, you can deduct the lesser of the contributions to your IRA for the year or the general limit. However, if you or your spouse was covered by an employer retirement plan, you are subject to different limitations not covered in this video. Non-deductible contributions. If you make contributions that are not deductible due to contribution limits, these non-deductible contributions become part of your basis in the IRA and are non-taxable when later distributed. You must maintain a record of these non-deductible contributions so that you're not taxed for them when you later take distributions from the IRA. IRS Form 8606 is used to track your basis in the IRA and is required to be filed with your tax return when making non-deductible contributions. There are many more rules and requirements related to IRAs. This is a very complex area of the tax code. Not quite as complex as the universe, but that was created by a much higher intelligence than the IRS. To learn more about this subject, you can refer to IRS Publication 590, Individual Retirement Arrangements, IRS Publication 590A, Contributions to Individual Retirement Arrangements, and IRS Publication 590B, Distributions from Individual Retirement Arrangements. That's it for this session. Thanks for watching the video. For more great 5-minute tax guides, check out the other videos in my 5-minute tax guide video series. See the list in the description below this video.